Hello everyone, my name is Wei, and today I will be presenting on the topic of stock options contract, specifically how call options can be used for speculation. Please check out our other videos to get the basics of how options contract works. And without further ado, here is call options for speculators. Investing by owning stocks can tie up a lot of money, and the more businesses you want to invest in, the more capital it ties up. With introduction of options, people can hold a single contract with significant notional value at just a fractional cost of the actual investment. The ease of leveraging makes options contracts ideal for speculation because it significantly amplifies the risk and return. So, how can an individual take advantage of call options contract for speculation? First, a speculator has to find a bullish company to speculate on. Recall that owning call options contract can only be profitable if the stock price moves up, and the profit has to be greater than the cost of the fee. And then check the available call options that fits the capital constraint, and narrow down the strike and the expiration date. After that, formulate a strategy such as entry and exit strategy. It is always good to have a plan before entering a position, because without a plan, the human emotion can cause irrational decisions. Once all that is figured out, it is important to execute and stick to the plan. Here is an example in speculating using call options contract. Let's say I have $2,000 available for speculation, and I selected Amazon to be the company I want to speculate on. This is the actual price of Amazon as of July 7th, 2017. Keep in mind the intention has to be bullish to use call options contract. For the sake of simplicity, let's round down the price to $978. Next step, I need to find a contract. So I pull up the options chain for Amazon. I pull this option chain off Yahoo Finance with link below the table. But your brokerage firm should have something that looks similar to this in StratoView. The first column shows the contract information, with the symbol, which is AMZN, the time of expiration, which is 2017 July 14, and the strikes. The last time shows the last time this table was updated, and the strikes column shows the available strikes, and the last price column shows the last price that was traded. Because each contract is equivalent to 100 shares, I actually have to multiply 100 to the last price to get the actual cost of the contract. So with $2,000, I can afford to buy at least one contract at all the strikes shown on this table. Just to demonstrate how much is leveraged using options, if I purchase 100 shares of Amazon, that will cost me $97,876. But instead, by owning a contract, it will cost me less than $2,000 to have that same notional value. Okay, back to the example. Let's say I do not want to spend more than half of my available cash for this position. So I will look at the strikes above 980, because strike at 977.5 will cost me $1,086, and any strikes below that will cost me even more. Now the next step is to create a strategy. Let's say I predict that Amazon will be $1,000 per share by expiration date on July 14th. That translates to about 2.25% increase from the current price, which is likely going to happen. So I will buy the contract at strike of 980 just because it is closest to the amount I wish to pay, and plan to close the position by selling the call contract on the day of expiration. With a strategy in place, the next step is to execute. Let's say I buy the contract with a strike of 980 and pays $970 for the contract. After the purchase, I will still have $1,030 available in cash. Let's create the scenarios for price of Amazon on July 14th of 2017. The scenarios are stock price becomes $980, $989.7, $1,000, $1,027, and here will be the results. At $980 and below, the contract will be worthless. Therefore, I lose $970, which is 100% of my initial investment. at $989.7 per share, the gain from the position will be $970 because there is $9.70 intrinsic value per share, and each contract is equivalent to 100 shares. But since I pay $970 for the contract, the profit is actually zero. This is actually the break-even point. At $1,000 per share, our target price, the gain will be $2,000. Because the contract costs $970, the profit is actually $1,030, and that is a return of 106%. At $1,027 per share, which is about 5% move, the gain will be $4,700. Because there is a $47 in intrinsic value minus $970 for the cost of the contract, the profit will be $3,730. That translates to 384% gain. As you can see from the example, with the risk of losing 100% of initial investment, you can gain 106% return on investment with the stock moving only 2.25%, and you can gain 384% with the stock moving 5%. And this is exactly how a lot of people speculate using call options. In the next video, I will present on selling call options. Thank you so much for watching. In this channel, we present on investment topics with plenty of examples. We cover investment terminologies, value investing, speculative investing, investment mathematics, and investment tools. Share, thumbs up, and subscribe if you like the video.